So it is time. So we would like to begin Mitsubishi Electric Corporation's consolidated financial result briefing for the third quarter of fiscal 2026. So allow me to introduce today's speaker, Executive Officer and CFO, Mr. Kenichiro Fujimoto. Mr. Fujimoto, please begin.
This is Fujimoto from Mitsubishi Electric. Thank you for joining our financial results briefing today. I will now explain the consolidated financial results summary for Mitsubishi Electric's third quarter of fiscal year 2026. So please turn to page 3. These are the key points of my presentation. I will cover the results for the third quarter of fiscal year 26, which will be referred to as Q3. Revenue reached a record high of 1,423.5 billion yen for the 3-month period of Q3, driven primarily by business volume expansion from increased demand in the infrastructure business area and the factory automation systems business. Operating profit, excluding the impact of the Next Stage Support Program for personnel structure optimization, reached 144.7 billion yen, driven by increased sales and the results of ongoing efforts to increase profitability and efficiency across all businesses. The operating profit margin of 10.2% marked a record high for the 3-month period of Q3, resulting in increased revenue and profits over the same period last year. The Next Stage initiative's third quarter results, including the accelerated implementation at subsidiaries, amounted to 74.3 billion yen. Operating profit, including this impact, was 70.3 billion yen. Furthermore, both revenue and profit on a net basis, excluding the impact of Next Stage, reached record highs for the cumulative 9-month through Q3. The full-year fiscal year 26 earnings forecast reflects strong performance in the infrastructure BA and FA systems segment, as well as changes in exchange rates. Revenue is projected to increase by 900 billion yen over the previous forecast to 5,760 billion yen. Operating profit on a net basis, excluding the impact of Next Stage, is projected at 500 billion, an increase of 30 billion yen from the previous forecast of 470 billion yen. Operating profit, including the Next Stage impact, is forecast at 400 billion yen, down 30 billion from the previous forecast. Our projection for the impact of Next Stage has been revised from 40 billion yen to 100 billion yen. This reflects the accelerated implementation of the program at subsidiaries originally anticipated for next fiscal year and beyond. We will secure performance by implementing steady growth investments alongside measures to improve profitability and efficiency. Now, please turn to page 5. This shows the group's performance for the 3 months of Q3. Revenue increased by 66.7 billion yen year-on-year to 1,423.5 billion yen, surpassing Q3 fiscal year 25 to reach the highest ever. Operating income, excluding the impact of Next Stage, increased by 17.8 billion year-on-year to 144.7 billion yen, another record high, and operating margin improved by 0.8 percentage points year-on-year to a record 10.2%. Now, please turn to page 5. This page shows the results for the first 9 months of the fiscal year. Revenue of 4,156 billion yen, operating profit of 369 billion yen on a real basis, excluding the impact of Next Stage, and the operating margin of 8.9% all set new highs for the first 9 months of the fiscal year. Net profit also reached the highest ever, even including the impact of Next Stage. Please refer to page 7. This waterfall chart shows the year-on-year changes in revenue and operating profit for the 3 months of the third quarter, as explained earlier. Despite the impact of a logistics subsidiary share transfer in the same period of the previous fiscal year, we achieved a significant year-on-year growth in both revenue and operating income on a real basis, excluding the impact of Next Stage due to the weak yen, increased AI and smartphone-related demand in the FA systems business, expansion of the infrastructure BA accompanying growth in UPS and power substation-related businesses for data centers in North America, as well as in the defense business, in addition to price improvements and cost reductions. Please see page 8. This shows the fluctuation in revenue and operating profit for the first 9 months of the fiscal year. The foreign exchange rate negatively impacted revenue by 5 billion yen and profit by 11 billion. However, if you exclude the next stage impact, on a real basis, revenue and profit both increased year-on-year, primarily due to expanded business volume. Please turn to page 9 now. This is the consolidated statement of profit or loss for the third quarter, 3 months. The cost of sales ratio improved by 1.7 percentage points compared to the same period last year, driven by the weak yen effect and improvements in the FA Systems segment and the Semiconductor Devices Group. Selling, general, and administrative expenses increased year-on-year, primarily due to an approximately 6 billion yen increase in yen-denominated amounts resulting from the weak yen. However, the SG&A ratio improved by 0.5 percentage points. Other income expenses in the same period last year posted a gain on the sale of shares in a logistics subsidiary, while this year we have recognized the expenses from the Next Stage initiative. The deterioration in financial income expenses resulted from the recognition of currency gains due to a sharp yen depreciation in the same period last year. The improvement in investment profits accounted for using the equity method includes the impact of the fair value assessment of existing equity interests in AG Melco Elevator Company Limited, which was made a subsidiary in the Building System segment. Please refer to page 10 for the consolidated statement of profit or loss for the 9-month period of the first 3 quarters. Now please skip to page 11. Turning now to the consolidated statement of financial position. First, assets increased by 284.2 billion yen over the end of the previous fiscal year. Inventories increased by 125.5 billion yen due to the impact of yen depreciation and progress in construction of the made-to-order business. We will continue to work on improving asset efficiency, such as by optimizing inventory placements. Equity capital increased by 225.4 billion yen over the end of the previous fiscal year. Of this, equity attributable to parent company shareholders, despite the impact of dividend payouts and the repurchase of shares, increased by 212.4 billion yen to 4,162 billion yen over the end of the previous fiscal year, driven by a net profit of 298.2 billion and the impact of currency conversion on the net assets of overseas subsidiaries due to the weak yen. The ratio of equity attributable to parent company shareholders to total assets increased by 0.6 percentage points from the end of the previous fiscal year to 62.5%.
Please turn to page 12 for the consolidated cash flows for the cumulative 9-month period. Cash flow from operating activities was an inflow of 342.9 billion yen, an increase of 34.7 billion yen year-on-year, primarily due to recording of net profit. Cash flow from investing activities resulted in an outflow of 138.4 billion yen, a 4.4 billion yen increase in outflows. This was due to higher expenditures for acquisitions, which outweighed proceeds from the sale of securities. As a result, free cash flow was an inflow of 204.4 billion yen, increase of 30.2 billion yen year-on-year. Turn to page 13, please. I will now explain revenue and operating profit by segment for the 3 months of third quarter. During this period, all business areas except semiconductor and device sales growth, while all business areas recorded profit increase. On the next page, for the 9-month period up till third quarter, revenue grew in all business areas except industry, mobility, and semiconductor and device. Profit increased in all segments except life. The next stage impact is included in elimination and corporate. Details for each segment are on the following pages. A full list of sub-segments figures is available in the supplementary information of page 23 and 24. Skipping one page, please see page 15 for the infrastructure business area. All sub-segments recorded year-on-year increase in both revenue and profit. In public utility system segment, order intake, sales, and profit all exceeded the previous year. This was driven by strong UPS business for overseas data centers and steady domestic transportation project. For energy system segment, demand remained solid due to data center expansions, particularly in North America. Orders, revenue, and profit all exceeded previous year. In third quarter, specifically, the operating margin improved due to the higher proportion of high-margin project. In Defense and Space System segment, order intake, revenue, and operating profit exceeded previous year due to expanding demand. Order intake remained high, and backlog has been increasing since the end of the fiscal half. We expect steady growth in both sales revenue and profit going forward. Page 16 discovers industry and mobility business area. In the factory automation system segment, driven by demand for smartphones and machine tools in China, as well as continued AI-related capital investment in Japan and China, order revenue rose YoY basis. Due to higher revenue, the sales volume, price improvements, and cost reductions, operating profit also increased from last year. Automotive equipment segment, the sales fell year-on-year due to lower sales in Japanese automakers in China and decreased car multimedia for North Americas. However, profit increased through price improvements and cost reductions. Page 17, please. This is Life business area. The building system segment saw growth in order revenue and operating profit led by increase in domestic renovation project. The air conditioning system and home product segment, sales in North America fell as a rebound from last year's rush demand ahead of the refrigerant transition. However, overall sales rose due to demand growth in Japan and Europe and weaker yen. Operating profit was impacted by rising material cost and stronger Thai baht, and declined on year-on-year basis. Page 18, please. This is digital innovation segment. Demand remained solid with order revenue and profit all exceeded the previous year. The semiconductor and device segment, order rose due to the growth in power semiconductor for railways and power transitions and optical devices for the data centers. Revenue was flat year-on-year, but operating profit increased due to an improved sales mix driven by optical devices. Page 19, please. The revenue by location of customers for third quarter. While overseas sales were boosted by the weekend and demand for air conditioning system and home product in Europe, and domestic revenue also grew, led by infrastructure. Consequently, the overseas sales ratio over consolidated revenue remained at 51%. Page 21, please. This is full year forecast for FY 26, fiscal 26. We have revised our revenue forecast upward by 90 billion yen to 5.76 trillion yen. Core operating profit is expected to increase by 30 billion to 500 billion yen, excluding next stage impact. The segment, we revised the higher revenue and profit for infrastructure business area expected to expand, and factory automation system was also revised upward, reflecting the weekend and continued demand growth. However, for air conditioning and system and home product segment, we lowered the volume outlook for North America. While revenue will rise, now we will expect a profit decline. We will also raise the forecast for automotive equipment and business system for higher profit and revenue, and for a profit forecast for semiconductor and device segment as well. This concludes my presentation.